Well, good morning and a very warm welcome to everybody that has jumped onto our webinar this morning. We've just clicked over to 9 o'clock, so I think we're ready to get started. We've got quite a few people on already, so fabulous to see everybody. My name is Jenny Wilcock, and along with our fabulous team, we run Sullivan Dewing Chartered Accountants and Business Builders based in Caringbah. Our focus is working with our clients to create profit within their businesses and then to extract them tax effectively so that they can grow personal wealth. This is besides the usual tax and accounting that we do just to keep the tax lady happy. I've got one of my clients that every time he talks to me, he says, I've got to keep the tax lady happy. I'm not sure if he's referring to me or the actual tax lady, but anyway. We love keeping our clients up to date, and today's webinar will do just that for you. Today, we are hosting for you a share market update with Andrew Tyrrell, Senior Investment Advisor, and Maria Zapata, Senior Investment Analyst, Asset Allocation and Fund Manager Research from Shaw and Partners. Andrew and Maria will guide you through the latest developments and trends shaping the share market landscape. They will provide us with a comprehensive insight and an overview of the Australian share market so that we can know where to invest, what stocks will bring us capital growth, and where we can look for dividend return. Before we start, some housekeeping. If you have any questions at all, please type them into the Q&A panel located at the bottom of your screen. We'll ask these questions at the end of the presentation. I'd like to now introduce Andrew and Maria. Andrew is a third-generation senior investment advisor with Shaw and Partners with over 25 years' experience in finance. Andrew helps many of our self-managed super fund clients invest in shares that produce good dividend return and capital growth. Andrew is a wealth of knowledge in this area, and I refer to him often. Andrew and I have a long history of working together, going back to our fathers, don't we, Andrew?
We do indeed.
And it's a pleasure to have him with us today. Maria is a senior investment analyst for asset allocation and fund manager research, joining Shaw and Partners after over 9 years working across financial markets, including roles in asset allocation, portfolio modelling, and manager selection. Shaw and Partners are one of Australia's leading investment advice and wealth management firms. With a national presence and over 30 billion of assets under advice, Shaw and Partners offer the intimacy of a boutique investment firm backed by the resources and scale of a major global financial group, EFG International, managing over 260 billion of assets. We are very fortunate to have Andrew and Maria here with us today. What I'm going to do now is just pull our presentation up and then we will hand over to Andrew and Maria. Okay, so just a reminder for the housekeeping, question and answers in the Q&A section, and over to Andrew first.
Well, I think it might be Maria first.
Oh, Maria first, I beg your pardon. Over to Maria first.
Well, I'll just quickly start on this one. This is just a disclaimer that everything we say today is general advice, which pretty much goes without saying. So that just means we don't take into account your personal circumstances, but I'll leave it from there and Maria can start and then I'll finish.
Sounds good. Thanks, Jenny. So I'll start off with the market outlook, more of the macro overview. If we just flick over perfect to that next slide. So of course, there's a lot of noise going on in markets at the moment, but what we're trying to focus on is really the big picture and just make sure we're properly allocating for the current risk environment that we're in and looking at the state of the world economy and markets through this lens or this framework here. So as you can see, we're pretty constructive by most of the green on the screen. For growth, after a wobble earlier this year, we have seen an improving trend. So that's a green for us on this tactical allocation framework. We see supportive conditions across central bank positioning and overall financial conditions as well. And as you can see there as well, valuations, those do remain a pretty persistent area of concern, but we find they don't give the best signal over the short term. So just one red flag there on our framework, and I'll kind of step through each of these measures. So the first one, if we flick over to the next slide, is our favorite measure of growth, which is the OECD composite leading indicators. So this give us a really good read or predictive power, I'd say, into looking at growth momentum. across the globe. So these composites are made up of things like building approvals, hours worked, so measures that give a read or predictive power to growth momentum. So they are a bit messy here when we look at country by country. So what we like to look at, if we go over to the next slide, is the GDP weighted measure. So this gives more importance to the economies we care about and have a bigger influence on global markets, for example, like the US. So this measure here, we can see trending upwards and improving. So that's why for the growth signal, we're seeing positive momentum. That wasn't always the case this year though. We did have a blip through Liberation Day, but since then where a lot of growth was revised down. But since then we've had a lot of growth surprises. So GDP for the US and for Oz, I'll quote as the most important, has been revised up and has surprised to the upside. We know GDP is backward looking, of course, but this does still tell us that the underlying momentum is pretty solid. So we're nearly at the end of Q3 now, and we've seen a continuation of this positive trend. So real activity data is continuing to beat across the board through Q3 as well. I'd highlight the risk for the US is probably that the labour market has softened slightly, but we still think that's probably not enough to threaten the slowdown. We're still forecasting to see solid and steady growth above 2% for the US, and it seems like the market still has enough confidence to fade any weakness that we've seen come through from the labour market side. So market's kind of looking at it as bad news is good news, and they're pricing any weakness as more cuts. More central bank cuts being priced in. For Aussie, quick comment there. Directionally, we think the Aussie economy is improving. So we're in a bit of a sweet spot here domestically. We've got really strong underlying wealth effect dynamic. We saw from the latest GDP print that the consumer was the one driving that, those positive revisions. So consumer momentum is definitely recovering. A trend through the most recent reporting season as well was trading updates so far for financial year 2026 were really positive in the consumer space. So we're seeing great underlying momentum there. And what that feeds through to is strong demand from the consumer is very favorable for equities and risk assets overall. Looking at the next pillar here, so central banks. This is a factor looking at how many banks are cutting or hiking. As we can see there, the latest print is at about 90%. So we've got a massive impulse of supportive policy, and this is looking globally. Looking at the next one, so the RBA in particular, because of that stronger domestic backdrop that I mentioned and stronger private demand, we have seen cuts taken off the table domestically. Directionally, we're still looking at a lower path from here, but we can see that step up from the darker line in the green about a month ago and a week ago to where we sit closer to today as a bit of a shallower rate cutting path. And that's been mostly on the back of just inflation measures ticking up a bit domestically. We follow the monthly CPI indicator, and that's actually jumped up pretty substantially from 1.8 to 2.8 to 2.9. So it just leaves the RBA in a bit of a tricky spot. Strong growth backdrop on one side, a marginal weakness on the labour market, and a little bit of heat in CPI numbers. So if we go over to the next slide, there we are, one and done is kind of what's currently priced in. We're looking at another cut potentially in November. The RBA will have its quarterly CPI print a week before that meeting. So that's kind of going to be the deciding factor for that one there. So the risk prior a few months ago was kind of 2 cuts with a risk of a third. Now we think it's really 1 with the risk of a second. As for the Fed, they're seeing a similar sort of picture there, a hard balancing act with a bit of weakness, as I mentioned, on the labour market side. And again, just inflation starting to step up, or there's some underlying heat in some of those core PCE numbers, which are the Fed's preferred measures. But as we can see against Oz, this is a much more aggressive kind of cutting cycle that's been priced in for the US Fed. So looking at this time next year, we're looking at rates probably 100 bips lower at 3.22. And if we flick to the next slide there as well, we follow the UBS forecast for the Fed funds rate here. We can see the terminal rate for the US is materially lower. That's stepping below 3%. So still a bit to go, and supportive impulse for central banks. The third pillar I'll mention here is financial conditions. So another measure we like to follow, the US Financial Conditions Index. We tend to find this rhymes very well when it's loosening. It's very positive for risk assets when it's tightening, vice versa. At the moment, that continuation of the easing trend that started in about early 2023 is intact. Again, that Liberation Day blip, but we've returned to easing of conditions. Credit spreads, which is over on the next slide, we'd say is one of the most important, if not the most important metric within the Financial Conditions Index. And we can see that that's at all-time tight, so extremely accommodative conditions there as well. As for Australia, similar sort of picture here, looking at our composites, conditions are supportive across the board. So that's been mainly from RBA, the RBA cuts, as well as the currency as well. And the last pillar I'll mention is valuations. So valuations have been a pretty consistent, a pretty persistent area of concern. They've been flashing red for well over 2 years. So the remain stretch, we're looking at the US and Australia here. So S&P 500 and ASX 200 for Australia, both trading at cyclical highs at the moment. So with valuations stretched, they do leave markets, we think, vulnerable to any negative policy or growth shocks. But what we do find is they can remain persistently stretched for long periods of time. So, for example, if we were to have taken the valuation signal as red from 2 years ago, we would have missed the pretty spectacular run we've had in equities over the last 2 years. So important measure to look at, but doesn't have as much importance, or we don't place as much importance on this in the short run. We can see there only 9% of 1 year returns are kind of explained by the equity risk premium. Versus if we look over the longer run, it makes a lot more sense. So if we flick over to the next slide, please. There it is. So 75% of 10-year returns are explained by the equity risk premium there. So still an important measure to look at, definitely matters in the long run, but we don't take as much of a signal for it in the short term. So just kind of to sum that view up, we still remain relatively constructive. At the moment, we're still fully invested close to our long-term neutral asset allocation levels across equities. And within equities, we are leaning towards a pro-growth stance. So I mentioned those forward-looking indicators for growth are all improving. Financial conditions are continuing to loosen as well, and we have support from central banks as well. So just bringing it to that framework, yeah, as I mentioned there, most of the green across the board with valuations, yes, that's red, but we don't place as much importance in the short term on that measure. And I'll just finish up on 2 points before I pass it over to Andrew. So with the improved and strong, solid domestic backdrop we're seeing at the moment, particularly the strength we're seeing in the consumer, we think this bodes really well for equities and risk assets overall, but we have a skew towards domestically exposed stocks at the moment. So there's definitely selective opportunities in the large cap space, but what we're highlighting here is small caps. So they not only re-rate in falling interest rate environments, but they do have a disproportionate amount of earnings from the domestic economy. So a great way to play momentum in the consumer. That's a space that we're looking at and interested in at the moment. And lastly, just our view on currency. I'll finish on this one here. I mentioned more cuts being priced into the US curve than here in Australia. So what that means is we are going to see a convergence in rates looking at August timing next year, so August 2026. We'll see Australian cash rates actually in excess of US rates. And what this means is just a narrowing of the interest rate differential. So narrowing an eventual flip suggests a higher Australian dollar. So just that last slide, over to the next one, we can see here currencies really correlated to the interest rate differential. That's a big driver for the Aussie dollar. So yeah, an eventual narrowing and flip of the interest rate differential suggests a higher Aussie dollar from here. So we think it's pretty prudent to look at hedged global equity exposure, and that's what we're implementing across our portfolios as well. So I'll stop there, pass it over to you, Andrew.
Perfect. Thank you. All right. Well, a lot of information to take in there. My charts are a little bit simpler without much noise on them, but it's but that was a great macro wrap, and it leads in quite well into this presentation here. So these are the charts of the ASX 200, which you would have seen similar ones last year. If we start on the ones on the left, the two charts are exactly the same time frame. The top one is just the ASX 200, not including dividends. The one below it is the ASX 200 accumulation index, which includes your dividends back into it. So if you're reinvesting all your dividends, the performance is, as you can see on the chart, the bottom one is about 2.6 times on that chart. So if you reinvested your dividends, so you'd be 2.5 times your money in that 10-year period. If you just took the index and you spent all the cash in the dividends, you'd be up about 1.7 times. But it just gives you the understanding of how important dividends are and accumulating dividends. So when we're comparing the Aussie market to like the NASDAQ or the S&P 500, because the S&P 500 and the NASDAQ don't typically pay dividends, they reinvest a lot of their money. It's best to use the accumulation index as the comparative too, which gives us an idea, but we're still lagging their markets. Like for a 10-year period, I think the NASDAQ's up 5 times, where the ASX 200 is up 2.5, but we'll talk about that later. I'm not sitting there saying we'll sell all the ASX shares and put it over there, but it's just diversification is something which we're certainly going to talk about later today, and it does work well. The one on the right is just a shorter time frame. It's just the last 3 years. You can see there in 2023, we had that pullback. That was where we'd already had the big rate cycle in 22, where all the rates, if everyone remember, if anyone had a home loan, they'll remember when the rates went from 0 up to 7%. In 2023, what that little blip there was, the markets got ahead of itself. The US came out and said, no, rates are going to be higher for longer, inflation's sticky. And then we had the Chinese property developers, if you remember to that, you may not, a couple of them defaulted on their loans, and that put the fear of God through the market. So we had that quick fall, had the recovery, and then also this year, which Maria was talking about earlier, was that Liberation Day, where Trump in March, April, came out, spoke tariffs, tried to tariff the whole world. We had that very quick sell-off. I've sent an email to a large number of clients on the back of that saying, guys, this is just a pure volatility spike. It is something to just, if we can, try and reinvest some money. And then we saw how quickly it rallied off that, because as Trump does, he just renegotiated. And I think they nicknamed him Taco, as in Trump always chickens out. I probably shouldn't say that. I might not be allowed into America anymore. But it's that's, you know, that was the outcome. And we've seen what's happened there. Just at the end here, we've got that little turn down, which is pretty much flattened out. That was just September. Like September for Australia, I think the market was down 3%, which a couple of factors to that. One, September historically is one of the worst months of the year. We pay a lot of dividends. A lot of companies go ex-dividend in September, which pulls that down a little bit. And it was just, we had some higher inflation number in Australia as well, which just shocked the market a little bit. But it's since then, we've pretty much flattened that line out and we're back on a decent trend. But they're the ASX charts, which again, the view for Australia and the markets, as you can see, is that pretty good trend line, which is going up. And with all that consumer data we had the budget deficit came out yesterday, which was a lot better than expected, which shows the underlying strength of the economy. The job markets in Australia is very strong compared to the US. And it's just keeping that forward momentum. We do have a lot of cash still sitting in the banks, and that's going to keep the market pretty well bid. So any volatility we had last night, as some of you may have read this morning, talking about a US shutdown in America. The last time this happened was basically 2018, 2019, just before COVID. The US market sold off 10% on the back of the shutdown. It then rallied back quite quickly. At the moment, the US market was up again last night, so they're not too worried about this shutdown. Time will tell, but the view would be, and I think the markets are of the same, if there is any pullback, it will be pretty well bought up. So I think the general trend is on this road, it will continue to move higher unless we see some external geopolitical shock. And that would probably, my view is a lot of that will come from China, or if this US job non-farm payroll number and the job numbers in the US continue to fall. They're the two biggest risks at the moment, I think, to the markets. But if we go to the next slide, what I'll do now is just go through a few stocks, which we'll go through a few stocks, but the banks is very topical. Everyone typically has banks. Most portfolios, especially super funds, would own banks. They're fantastic companies to own because they are huge dividend payers. They have huge amounts of franking. They're all fully franked. For example, ANZ, Westpac, they're yielding about 7% a year. CBA, which you should be able to see that is the top right, that's yielding less than 4%. We'll talk about that on a second. And then NAB's yielding probably grossed up around that 5.5% to 6.5% as well. But on the chart, you can see that ANZ, NAB, Westpac, they had that trend line lower all the way through 17, 18, 19. A lot of that was on the back of, if you remember back to the Royal Commission into banking. Westpac came out almost the worst of all three of them, but the Royal Commission and the banking, that really hurt the banks, and the perception of the market were the banks are evil, they're stealing money from everyone, so we don't want to be there. CBA, at that point in time, you can see their chart was quite flat through that period of time. It was deemed the best bank, the cleanest bank, and missed a lot of the big warning signs, or didn't get caught up in a lot of it, and they went through it quite well. 2019, 20. Everyone can remember that was COVID, so we saw those big pullbacks in the banks. CBA had a lesser pullback, but still quite large. And then from there, the banks have moved on quite well. And we've seen that huge rally through 23, 24 and into 25. That was something where if you look talking to analysts in the market, every analyst in the market had to pretty much sell on all the four major banks, especially CBA, and they've had it horribly wrong. I was of the view that you could buy these banks, especially when they were the NAB, Westpac, ANZ and CBA as well through 23, 24, because their valuations weren't expensive. The job, the economy, everything was moving the right direction and rates were coming down. And hence you saw the banks moving. Where we are today on the banks, ANZ still showing fair value. When we talked about that PE and the valuation metrics, CBA, it hit $190 a share back there. I think it was 2-3 months ago. I can't remember the exact date. It was the most expensive bank in the world. It was trading on a PE of north of 30 times. It had a price to book value about 3.5 times book value. Put that in perspective, Westpac and ANZ at that same time were trading on a PE, I think Westpac was 16, ANZ was 14. Westpac's price to book was 1.6 times, ANZ was about 1.5. So CBA was priced over double ANZ and Westpac, which was just unheard of. Now we're seeing, as you can look at the three charts, ANZ, NAB, Westpac is still moving higher and CBA has come off a bit. And that is just purely that valuation ground where people are selling out of the CBA and moving them back into the other majors. Biggest risk to the banks. We've spoken about this a few times, but it's inflation and higher interest rates. Yes, the inflation number came in a little bit recently, which was a bit sticky. We saw a quick sell-off on the banks, which they then recovered. But that's one of the risks. Job losses at the moment is not happening. We've got very strong labour markets, which is a positive for banks. You then have a slowing economy, which is not happening. We're seeing that through our GDP data. That's a positive for banks. And then the last one is house prices. Well, unfortunately, we all know which way house prices are going, which is great for the owners, not so great for our young kids who are never going to buy a house in Sydney. But it's something which at the moment, yes, the market is saying the banks are expensive, but there's not a lot of risk to their earnings. And it's just something where I think you can trim around in the banks a little bit, like moving from CBA into an ANZ or Vicky Rocker, but it's just something at the moment I don't see a lot of downside risk to the banks, because if this market keeps moving higher, the banks are going to have to move higher as well, but to a lesser degree. I think CBA is probably done at the moment. I think that 160 to 180 is probably going to hold CBA in a range for a while. But the other three banks, I think it could still potentially grinding higher, more likely Westpac, ANZ. I think NAB around 45 is getting fully priced. I think if Westpac gets through 40, it's close. But ANZ in the low 30s, I think has still got room to go. But that's in a nutshell the banks, but I'm sure there'll be questions on them coming up. If we go to the next slide, which is again, this is all the big end of town. So the banks make up 30% of the index. BHP is the second largest stock, CBA is the largest, and then Rio would be in the top 10. Again, these stocks are predominantly iron ore, but the big thing is like the BHP is iron ore, copper and coal and potash. The iron ore part of BHP is about 50% of earnings. They're the lowest cost producer in the world. Their all-in cost is around about $50 a tonne. They're producing 300 million tonnes a year and they're selling it around $85 a tonne. So you can just think of the pure cash. They're making almost $9 to $10 billion just from their iron ore part of the business. So that's something I like. Even if everyone's forecasting iron ore down to about $80 to $90 a tonne in the next 2 to 3 years, they're still going to be very profitable in the iron ore. But they're a great business because they're moving. They used to be 75, 80% iron ore. They're now focusing a lot on copper, which is all this electrification trade. So electric vehicles, wind turbines, or the solar. The copper is vital. They're a great business. Focused on China as well, which we can talk about later. But I think BHP's good story. It has been in a bit of a downtrend, but I think around $40, it's still got a long, good story, good price, yielding close to just sub 5. So grossed up is probably mid 6s. Don't see a lot of risk to their earnings at the moment. Rio, similar business to BHP. They're doing something now which BHP did a few years ago, and that was simplifying their business. So BHP's got those 4 core assets. Rio had multiple assets, and they're just simplifying that now, going back to 3 core, which one, iron ore, which is still about 65% of earnings. 2 is they're looking at the aluminium business and the lithium, which is a big part of Rio Tinto. And then the third one is just into, sorry, I've just lost my point. The third one is in the copper. And that's something where Rio again focuses on that. So they're both, again, iron ore, the price has come down from the $200 a tonne where it was a couple of years ago, which is fantastic. But it's just simplified their businesses. They're moving out of iron ore because they see the future for iron ore is a little bit hard to predict, and hence they're moving into these other assets and these commodities which are vital. So there's 2 very good miners. But if we move through to the next bit, so that was the pretty much 40% of the market in those first 2 slides. So as we move forward here, these charts, if you look, the one on the left is the 10-year, the one on the right is the 3-year chart. Amcor is, in my view, a great company. A lot of clients I talk to, we have Amcor. It has come off quite a lot. And you can see the last big move was on the back of their results, which are out in August. Amcor reports quarterly. The majority of the market have a buy recommendation on Amcor with a price target anywhere from $16 to $20. It's currently trading in the low 12s. Why? Amcor during the year made a very large acquisition of a company called Berry. So Berry was number 2 in the market. Amcor was number 1 in the market. Now 1 and 2 have merged, so they're the biggest in the market in global flexibles and packaging in the world. We saw their results came out. The results weren't too bad. They're pretty much almost in line with the numbers. They had some cost impacts because of cost of living and everything, and all the inflationary costs had come through on the business. But one of the big surprises was the actual demand levels were down. It wasn't because they were losing market share. It was purely a fact of the consumer, which, as Maria was speaking to, the consumer is coming back, especially in Australia, and the effect that the consumer should continue to move quite well in Europe. America's got a little bit of a speed bump at the moment with the job losses, but if that can stabilise, that consumer demand will come back, which will bode well, 1, for Amcor, but 2, one of the big things is with Amcor, the deal they made, the synergies on that deal are upwards of about $650 million. Amcor's got a great history of delivering on synergies. The market was a little bit worried because they hadn't delivered anything. I said, well, the deal only happened 3 months before the results, so it was pretty hard to deliver on synergies. Next year, they're talking 250 million in synergies in FY26. If they can deliver anywhere near that figure, the growth target from the company and the guidance is 15% earnings, uptick next year. From that, the forecast in the market is anywhere from like 30 to 40% over the next 12 months if they can deliver on these synergies and these earnings. The yield is 6%, pays quarterly. One of the things with Amcor, it's not franked because all their earnings is overseas, but it's just a company in the results. that has been sold off, and in my view, it's been sold off too far. And this is a consumer-led recovery, and I think Amcor will do quite well on the back of that. On to the next slide, which is Woolworths, which everyone will either love or hate Woolworths. Everyone shops at Woolies or Coles, or 85% of the population shop at Woolies and Coles. As you can see here, the Woolies versus Coles charts, the top ones are the 20 years, the bottom ones are the 3 years. On all of them, you can see Woolies pretty much was outperforming Coles all the way through up until about 23. Then Woolies has rolled over. You've seen the big uptick in Coles, and Coles has outperformed Woolies quite substantially for the last 2 years. And it's something where these two typically trade quite closely. One will perform better than the other for a period of time, and then it reverts. Woolies, if you remember back, we had the Senate inquiry into supermarkets on price cartel behaviour, price fixing, etc., etc. Woolies came out the worst from that. If you remember, we had the CEO, Bernanke, had a very unfortunate 7:30 report where he came across and he's not a great public speaker, but he was a great CEO. He didn't come out very well from that. The Senate inquiry was really attacking Woolworths more than Coles on their price gouging. And the public perception then was, well, we don't like Woolies, and a lot of shoppers have moved across to Coles on the back of that. We're seeing, like, Woolworths growth is still happening. Like-for-like sales is up still 2.1% for the year, so it's still increasing on last year's sales. On the same thing, Coles' like-for-like sales are up 7%. So you can see the difference in the growth between the two. My view on this one is, well, Woolworths at $27 or below is good value. It's a fantastic business. The franchise is not broken. Woolies and Coles are 85% of the supermarkets in Australia. They're very defensive, as my father used to say, and I'm sure Jenny's was as well, that people have always got to eat. It doesn't matter what the economy is doing, these companies are still going to make money. Yes, the profitability is not ginormous. I think they make about 7 cents in the dollar, but they're not going to blow up. And I think Woolies at $27 as a long-term trade. I think this disparity between the two might continue for a little bit more, but I think it is a turnaround story, and it's a lot better than $27 a share. The yield on Woolies grossed up is about 4.6%. I think they yield about 3.2. Add the franking back, so you're close to 4.6, which is still more than you get in a term deposit. But I think it's more a growth story at the moment in that recovery trade for the Woolies versus Coles. You can do a switch, which I have been doing. If you're holding Coles, I've been selling some Coles and putting it back into Woolies, so you're staying the same exposure. But and if you don't hold either, I think Woolies at 27 is a good buy. On to the next one, Santos Oil and Gas. Very topical at the moment with our Prime Minister, who doesn't like anything to do with fossil fuels. This chart, you can see the 20-year chart, it's moved around a little bit. The COVID hit oil and gas very, very hard. As you can see, that massive fall from $8 down to almost $3. I think it actually did go sub $3. And then the recovery on the back of that. The reason behind that is oil and gas is a barometer for global growth. And if global growth is anemic or slowing, you don't want to be with oil and gas because it's just a barometer there. At the moment, it's very political, fossil fuels. However, we'll talk about it in a minute, read data centers and AI and this massive push into technology. It is a huge demand on energy. At the moment, you're seeing the rest of the world go nuclear or start building up more and more reactors, but that's going to take years before it gets into play. The fastest way to get energy is by gas and then the oil side of things as well. And we're seeing with Trump in his big push on fossil fuels saying we're not slowing down fossil fuels because we need to win this arms race in AI. So oil and gas, in my view, is still a good place. Oh, back on that other one. Sorry, Jen. But still a good place to play. You see on the right chart, we had that big rapid pullback recently. That was a company called XRG, was looking to buy Santos at $8.95. That fell over in the last minute. We always had a view that FIRB was probably going to block the deal anyway because it was a foreign company buying Australian assets. But we think that sell-off is massively overdone, and that's why I'm talking about it today. I think anything sub $7 on Santos is good. They've moved basically from a massive capex cycle. They're now actually in a big revenue cycle. So they've got the big Barossa, which is LNG project in the Northern Territory, which is coming online. First gas was delivered in September. So they're talking the sales are ramping up very, very quickly for that one. And we've also had the Picker Oil up in Alaska is expecting for first delivery in first quarter 26. So these are two huge revenue things for Santos, which will push this very, very large free cash flow coming in. The yield at the moment is 5%. They're talking of that going to 7 to 9, and then franking will come back in 27. But that, in my view, is a 2 to 3 year story, and I think anything sub 7 is a good price for Santos in that one. CSL, this one is a tough looking chart. CSL was the biggest stock in the market back there in 21, 22. It's now third, maybe fourth biggest now. CSL is a story where I'm not saying the bite yet. This one at the moment, we're not 100% sure where the bottom is. Like CSL, as we know, is the blood plasma company, Australian and America. It does a lot of the vaccines. It does blood collection. It does a lot of that work and a huge amount in biotech in research. What's happened with CSL, it didn't get a part in COVID, which hurt their earnings a little bit. But the biggest thing at the moment, and this is where the sell-off came in, is their guidance disappointed in their recent results. And the markets look at guidance as a big thing. This is the outlook statement for CSL. Trump, with all his tariffs and pharmaceutical things, is not helping CSL. Even though CSL has a huge amount of business in America, that's a big cloud over their outlook as well, and their earnings missed. And it was just a pure factor that, again, with vaccines, as we've seen here in Australia and especially around the world, people are sick of needles at the moment, and that's certainly hurting CSL's earnings. So that's one to watch. I'm not saying jump on board yet. It is a great company. It was the biggest on the ASX, and it is just having a tough time at the moment. The current CEO has only been in there a couple of years, and the market's not 100% sold on him either. And that's something where, because he's come on board and he said there's a vaccine unit part of CSL, which he wanted to sell to try and raise some money. The market didn't like that. And that was another reason this thing sold off so heavily, because they said, well, it's a great business unit. Why sell something great? Because then all that happens in the future, the company's smaller. So with stocks, and the way we look at stocks as well, management is vital. Like, you've got to have belief in the management. And at the moment, the market's a little bit hesitant on the management and the outlook statement. Hence this sell-off. So at the moment, it's like catching a falling knife. I just think we'll sit and just watch CSL for a while. But again, that one you're not buying for an income. It is purely a growth story. But at the moment, it's looking a bit sick. So it's just, I put it up there because it is such a big company. But I'm not saying, I wouldn't sell it if you're holding it now, but I wouldn't add more to it. It's just one we can watch. Okay, this is a smaller story. So the next few slides, we're going to talk about this whole global tech and data centers and everything like that. So Southern Cross Electrical is in that small to mid-cap space, as Maria was alluding to. When consumer demand's growing and the economies are growing, small mids do quite well. As you can see here, it didn't do much for about 8 years. It was trading sideways. Majority of Southern Cross Electrical's business used to come from the resources sector, with the BHPs, the Rios, everything like that. That used to be almost 100% of the earnings. Now their earnings is built, a lot of it is in data centers. It does a lot of corporate buildings. It's got big contracts with Mirvac and Goodman Group and things like that. So it's spread its umbrella out. It works across multiple sectors. And the big part of it is this data center growth, which we're alluding to. So data centers are vital for AI and technology and the cloud. And so if we all look at our mobile phones, in the old days, your mobile phone was just purely there to answer phone calls and maybe send the odd text message. Now the mobile phone is everyone's life. You've got through all the streaming profiles, everything. But the biggest one is the photos. Like the new phone, I think the new camera is like a 48 megapixel camera. If you've got a family of 5, all of a sudden you're at a gigabyte by the end of the week, let alone what's happening every day and all this collection of data. And that's got to go sit somewhere. And it's the same as every business and company. Like I remember when I came here, when Dad was working in broking, he used to have files. Every client had a file. Now all that is online. So all the files are now in the cloud as well. And it's just something that data centers is the only place where this all sits. The demand for data centers is astronomical. And then you need companies like Southern Cross Electrical, which sits between the consumer and the data center and does all the electrical works. I think this company they had a great result. They're up 45% year on year. The EBITDA was up 37%. year on year. And then the cash on the balance sheet's at $80 million, which is a huge amount of cash. It's a $500 million company. And we just like the outlook. The story is good. It's got positive earnings momentum, and we think it's just going to continue to deliver. And we've had a few stories in the recent years. One was SRG, another one was Ventia, and then Southern Cross Electric was in that mid-cap space. It is fully franked dividend yield. I don't have that with me, but I think it's about 4 to 5%, and that's fully franked as well. And I just like that story, and it fits into that thematic of AI technology and data centers. So if we move to the next one, Goodman Group, this again is this data center theme. Goodman Group was a logistic. It was traditionally was a real estate investment trust, which were big box warehouses in infrastructure and logistics. Goodman Group now is an asset manager of those big box warehouses, and they've pushed a huge amount of their earnings to data centers as well. We saw in 24 into 25 that big pullback. If people may remember, they may not. That was when China came out and announced DeepSeek, which was was it DeepSeek? I think it's DeepSeek. They came out and announced that big AI chip, which was in competition to NVIDIA, and apparently it's a lot more efficient. Therefore, you would have less demand for data centers, etc., like because it would hold more data. This whole thing, and Goodman Group got sold off. So did the Nasdaq quite heavily on the back of all that. It has since recovered. Our view with Goodman Group is anywhere in the mid to low 30s. It's a good long-term buy because it is the biggest data center provider in Australia. It is global. It's building them all around the world, and they have a huge amount of power capacity. And this is something with data centers. One, you got to build it, but before you can build the data center, you have to get the power. And out in Macquarie Park in New South Wales, they've stopped building data centers because they don't have the power. Capability, and this again bodes back to that oil and gas trade with Santos. These data centers, you have to guarantee the power because they cannot go down, and this is a bit you got to get that power from the grid, and Goodman Group has 5 gigawatts of power, which is a massive power bank in the spectrum of things, and they're able to roll that power out, and they're building a lot more data centers to use that power, so they're in a very good space, and we quite like them. Biggest issue of Goodman is they're not fully franked. They don't pay much income because it all goes back into paying down their debts. But that's just the long-term story. And then we move into a couple of tech names. And this is the bit where these tech stocks is something where traditionally with super funds in Australia, franking credits are vital, and dividend yields. And you want the yield because you get the franking benefits back in your super fund. This is something where Aussie market is doing very, very well, and it continues to do well. And in the long run, it will do well. It will move up and down, but it's in a very good space. I see more risk to the upside than to the down. You will get the odd shock and volatility, which will push markets around. But I think I still like the Aussie market. These two names, basically the Nasdaq and the Plato on the next slide, but we'll stay on this one, Jenny, is basically pure about diversification of your portfolios and trying to get exposure to some of the fastest growing sectors of the world. And at the moment, that sector or index is the Nasdaq and the tech space. It's something where Trump has made it, and we can't always go on and talk about Trump, but the sheer volume of money being invested in technology and in this arms race is astronomical. Like we're talking trillions and trillions of dollars is being invested into this space. And who's at the forefront of that? Well, it's the big US tech companies. Where are the big US tech companies listed? It's on the NASDAQ. So the top one is just the NASDAQ Composite Index. The one at the bottom is NDQ, which is the NASDAQ 100, which is an ETF listed here in Australia, where you can buy NDQ on the Australian stock market and get exposure to the biggest 100 companies listed on the NASDAQ. The right side, you can see the performance. I think the NASDAQ 100 has a performance fee of about 48 points. That's typically almost the difference between the performances of the whole for the year, etc. But you can look at the numbers, like a 1 year number for the index was up 24%. The 3 years is annualizing 23%. The 5 year number's down quite a bit because if we remember 4 years ago, 2022 was not a great year for markets, especially tech. And this is something on the NASDAQ. The way I look at the NASDAQ, you will have 4 fantastic years and then you can have a nosebleed year because it is pure growth story. But it's something where I think I've got NDQ, I've got Plato in my portfolio, but I think you're just getting a little bit of exposure to this arms race in AI. It is the new arms race. It is China versus America. And at the moment, China came out with that DeepSeek. Trump's got NVIDIA and all these other ones, and he's pushing very, very hard because it controls everything with defense, all the way through to medical, all the way through to the enhancement of these big tech companies. So it's something that's a little bit of exposure story. The next slide is another company that I like in that similar space. NDQ is a passive fund. What I mean by that, it is purely computer generated, and it is just market cap weighted to the biggest 100 stocks on the NASDAQ. Plato Global is an active fund manager. They track the MSCI World Index, which is their benchmark. And again, I've just put their numbers up there at the top of the screen. Their performance has been nothing but exceptional. It is ranked as one of the best funds in Australia for global exposure. They are a long short fund as well. So what that means is they can go both sides of the market. So they can sell short sectors to balance out, or they can sell short so they can go longer in certain things as well. But it's just they're two that I like. They give you that global exposure, and they've had fantastic track records. Plato Global being an active fund, there is the fees, it comes out of the unit price. They are a little bit more expensive, but I think if they're performing the way they're performing, I don't mind giving up a little bit on the fees. But that's just something, gives you global exposure, which, yes, through Australia, I know we've talked about it previously with BHP Rio, you get global exposure, particularly China. With the Amcors, you can get global exposure in America and Europe. The banks, you don't. But these ones are just giving you exposure to that tech space, which is, I think, at the moment, everywhere you look, everything we do is all so tech focused. And I think that's something you don't really get a lot of opportunities in Australia to buy into that big tech space. But I think that pretty much is my last slide. Yes.
All right, that was wonderful. I'm actually going to stop sharing the screen for a few minutes while we just take some questions. So I would say a big thank you to both of you this morning. We had an excellent macro analysis from Maria. That was really, really interesting, and then the more micro look from Andrew. So yeah, very, very happy to hear that. So what I would encourage people to do now, if they could, is just pop any questions that they have in the Q&A panel at the bottom of the screen. And then we can have a look at those questions as we go. There's I think there was a few interesting things that came out of both of your presentations this morning. So interesting, Maria, on the interest rate side of things. So we've got a rates announcement today, and then we've got your table there, basically saying that the rate cuts are off the table for a little while. So it might be a bit of a non-announcement today, you think?
Yeah, definitely. The market's pricing about 5% for a change, 95% for no move. So I think that's the way it's gonna go today. And the next live meeting will be Cup Day. So I think it's the 5th of November, if I'm not wrong. Yeah, it's the next RBA meeting.
I think it's the 4th of November.
The 4th? There you go, the 4th. And that's still about 50-50 for that day. So it'll really be that CPI print that comes in a week before, which we think will be the deciding factor for that meeting. So yeah, probably one and done for the RBA.
Yeah, so that's the one to watch. I've always found it interesting that they generally do a rate cut announcement half an hour before the Melbourne Cup race.
Yeah, exactly.
Packed agenda.
That doesn't it? Okay, that's good. We haven't sort of touched too much today on gold. So gold's sitting at record highs. What's your thoughts on gold at the minute?
Yeah, I find gold is very tricky at the moment. Yes, it is at record highs. I've had a lot of questions about gold and silver, and it's something where gold companies have been tough investments because gold companies should follow the gold price. So like if you look at BHP and Rio, they follow the iron ore price quite closely. Yep. Gold companies in Australia especially have had a very poor record of following the gold commodity price up until recently. So even when gold got to about $2,500 to $2,800 an ounce, like companies like Newcrest, which is now Newmont, they were going down. And you're going, how? Because they will always come out with some way of having a bad result, or cost blowouts, or mine disasters, or something going on where the actual commodity itself has done very well. Now gold stocks have actually gone exponential on the back of this gold price. It is an interesting one because gold typically is a defensive trade. It's a defensive asset.
Yeah.
The reason I'm thinking gold is moving more at the moment is less on global economies and more on the perception of the US dollar, because Trump wants to get this US dollar down, and he's been pushing very, very hard on Bernanke, and he will come, I think not yet, but soon he will then control the Fed because he's getting one of his puppets in there, and then he's going to push this dollar lower through rate cuts and things like that. And again, with that US rate cut move, if those moves do play out, the US dollar is going to get weak. The big thing on that is to keep a look though, but against the euro and the pound, the US dollar has already fallen quite a bit. It's just against the Aussie dollar it hasn't really moved. The Aussie dollar has been quite weak as well at the moment. But against the euro and the pound, the dollar's moved. But the view is that yes, gold's up because the US dollar outlook is still negative. But also on the side of that, I think there's a lot of people moving into gold because they've been sitting on a huge amount of cash. They're too worried about the equity market because it's been hot. The tech space has run. So they're using gold as that safe haven asset, thinking there's going to be a pullback because you don't often get everything moving up. And that's where the markets are quite tough at the moment as well. So
yeah, because
would I buy gold? I don't know, but it is tricky at the moment.
Because we've got gold at record highs. We've got potentially no interest rate cuts or maybe one interest rate cut. We've got the strong OECD growth. So they seem a little bit contradictory almost. Yeah.
Very much so. And that's where it's quite hard to predict any short-term movements. But yeah, there's certainly a lot of money gone into gold. And a lot to do with that as well, I think, is in China as well. Like China's cash situation in the bank is about $20 trillion, which is an amazing number. And because China, the consumer, it's something where we had a lecture recently with the offsite where they're pushing and they're trying to get that middle class in China to move. And that's why I'm not too concerned about China, because the volume of money they're sitting in their bank accounts over there, and they're a big buyer of gold as well in China. And I think that's pushing this gold price as well.
Yeah, interesting. We do have a number of our super funds that do hold bullion, both gold and silver, which is quite interesting for the auditors actually. All right, a question from one of our participants today is on James Hardie. What's your thoughts on James Hardie? Is it a buy, a hold, or a sell?
Yeah, it's a good one. I was going to put James Hardie in here. I've liked James Hardie, and the thing that really hit home on James Hardie is one, the US economy. Like we've had rates in America very high. Their 30-year rate, which when you buy a house in America, you get a 30-year fixed loan. They're sitting around 7%. So when they traditionally were sitting in the 4s and 3s, where it's been very expensive to buy a house, you're not getting that consumer redevelopment, which is James Hardie's bread and butter, because they are a builder and they want that. It's something where at the moment the job losses, the sticky inflation, it's not looking good for Hardie's. They also made a recent acquisition, which the shareholders didn't like, and that sold off originally, and then the result came out and they missed on the results, which that was a bit of a surprise. Like every analyst in the market, it's very heavily covered stock because it is in the US and is in Australia, and every analyst got it wrong. And the stock got absolutely walloped. I think it got down to about $26. It was sitting in the 30s. It was $60 like 12 to 18 months ago. There is a point where James Hardie has value. I think it's bounced up a bit off $26. I was trading around the edges at 26, but just chipping away lightly because you just didn't know where it was going to go. But if the US job market stabilizes, if they do get these rate cuts through in America, like we're talking about, you'd expect that's going to have a recovery, but it's going to be consumer-led and interest rate-led. At the moment, if the job market hold, it will get better. But it was just the speed of the sell-off and the fact that this company reports quarterly and the analysts got it so wrong from one quarter to the next quarter. It does put a lot of fear through people, and a lot of the big funds around the world, they will sell first and ask questions later. And that's what you've seen with this one. I don't mind it. If you're happy to hold it for the long term, I think it will get better. But yeah, short term, it's just tricky.
Some good thoughts on that. So if you're an investor and you're looking to balance your portfolio, you've mentioned a number of stocks in your presentation today. So if you're looking at balancing short-term growth with some longer-term growth, what would you say your short-term growth stock would be versus your long-term growth?
Short-term growth, I think, a couple of them in there. Amcor is more long-term. So that's definitely a long-term turnaround story. I think that one, if they can deliver on these synergies, that's an $18 to $20 stock versus going to take time. I think short-term out of that presentation would be the Southern Cross Electrical. because that is very much in that hot space at the moment where it's all those data centers. The fact that the electrical work, the connectivity is vital to get these things work, and they're in a good niche spot. They're small and they're going to continue to do quite well, and I quite like them. Definitely, that would be the easiest two of the presentation in that short term versus long term.
I think the Southern Cross Electrical would be particularly attractive for the self-managed super funds with its franking, whereas the Amcor doesn't have the franking for a little while. Yeah, so that's good to think about. I get a lot of questions from people on ETFs and whether they think ETFs are a good thing or not. I mean, you've talked about one ETF today, which is the NDQ, the Nasdaq 100. Yep. What are your thoughts on other ETFs?
Yeah, as I was actually talking to your brother on this one yesterday. It's something where the ETFs, I use ETFs quite a lot for global exposure. Like for here, domestic exposure, I find with our market at the moment and with the weightings of the ETFs, like it's going to be index weighted, especially if you buy an ASX 200 index. And in that index weighting, the banks are 35% of the index, and I don't particularly want to be buying 13% of the index as CBA. I don't particularly want to be buying 13% of CBA, where I think ANZ's got a better weighting than CBA in the performance. So domestically, I prefer to buy individual stocks and think, I can match or outperform the index on that. Globally, I use ETFs quite a lot, and especially thematic driven. Like I like the FTSE 100, which is the London Stock Exchange. You can get exposure there. They've been doing quite well. The Nasdaq 100, which was the NDQ we spoke about, that actual PGA 1 Plato Global Alpha, that is both an unlisted fund but an ETF as well.
Right.
And I think they're easy ways to get exposure because, as I said to clients, like to go buy Apple, you're paying a huge amount of money and it's one stock. Where if you can get the ETF, you get that diversification instantaneously. So it reduces that concentration risk. And I think the other benefit of they're listed here. So we can trade them on our time. I do trade internationally for a number of clients, which is not an issue. But it's just more work, trickier because it's overnight and it's just the costs are higher. But I think ETFs certainly have value. Then they can be thematic driven ETFs. So you can buy gold ETFs, which no doubt you've seen doing the reports. You can buy ETFs on drugs. So all the big drug companies of the world, there's an ETF on that. There's ones for food. There's ones for solar and wind. They're amazing what they can do. Robotics is another one, which is front and center on ETFs. So they do have a place, definitely.
Yeah. I tend to see that the franking exposure on them is often lower than the direct invested shares, which may suit a super fund or may not suit a super fund.
Yeah.
I support you. I think they're very advantageous for the global shares, and some of those specific categories. Okay, all right. One from a first-time investor. So if you were starting off today with the share market, what would be the 5 stocks that you would buy?
Wow.
I gave you 5.
Harry 5. Well, if you're self-managed super Aussie and you look at Aussie stocks, like you could pick 5 sectors. Like you could buy a BHP or a Rio, you could buy a bank. I think at the moment, my bank would be ANZ. That can be up for conjecture, but I think this new CEO, ex-HSBC, who's just started, is doing some good things. Yeah. You'll see the government talk about job cuts and things like that. Well, it's a company, it's a business, so they're to make money. So I think you could go BHP Rio, a bank would be ANZ. You could go boring and go Telstra. That's in the press at the moment, mainly Optus, but that's a good, it's $4.80. It's not broken. It's defensive, and it's got a good income and yield. Woolworths is another one, which is a turnaround story. So you're going to get growth out of that. I think that's 4. And the 5th stock, what have we got? We've got telco, we've got miners, we've got a bank, we've got a supermarket. You could go into consumer, which we talked about discretionary, but that's pretty tough at the moment. That space is really run. Like you had a Wesfarmers, but at 90.
Yeah, I was going to say Wesfarmers. Would you?
Yeah, which is a fantastic company. $92 is getting up there, but it's and so that's there. You've got JB Hi-Fi, again consumer delivery, but again at $110, I think it's here at the moment. It's unbelievably high. So probably not. I'll leave them out. You could actually look at that Southern Cross Electrical for a little bit more growth, but still good income. Where else are we?
So it seems to me that what you're suggesting is that you diversify amongst the sectors.
Yeah, if it's just
Yeah.
5, and they're the big names, and because you're not going to, and especially first-time investors, you don't want to put them into a higher risk stocks, because the last thing you want to do for first-time investor is to burn their fingers, because it's, you know, they're not going to come back too quickly. Or you want to get defensive stocks, let them grow, and then we can look at adding, you know, other stocks and more risk down the track.
Yeah, absolutely. And it's something I talk to my clients about all the time, to make sure that they're having these conversations with their kids, so that the kids are getting exposure to, you know, to the share market, because I run many meetings with clients, and I can always tell the ones that have had these conversations with their parents over time, they're a lot more comfortable to do this share market investing. And there's pros and cons on all sorts of investing, but when they have a good understanding from a young age, I find that they're a lot more open to the opportunities that are there.
No, definitely.
Yeah, absolutely. Okay, well, I think I will leave your questions there. That's probably enough grilling for the both of you this morning. But I would say thank you very much for both of you. That was really incredible insight today. Very valuable. And I know our attendees will be delighted to have heard it. And we will be sending a recording of our presentation out to many people actually. So your knowledge this morning will reach far and wide. So we appreciate that very much. So I would say also thank you to our attendees for joining us this morning. The copy of the slides and the recording will come out later. If you have any further questions at all, you can reach out to Sullivan Dewing, of course, and we are happy to answer those questions for you. But I would say as well, have a wonderful day. Enjoy the beautiful spring weather, and thank you very much to Maria and Andrew for your very wonderful tips this morning.
Perfect. Thanks
for having us. Have a good day.